Welcome to Ask an Advisor, where we here at Team Clark go deeper on all things investing. I'm Krista DiBiase, and I have the pleasure of being here again with Wes Moss.
Thank you, Krista. I'm wearing a jacket today. I don't know if I've done that on the show. I wear a jacket a lot. I know that I was wearing a vest for a long time here.
Yes, you're looking very sharp today. If you're watching us on youtube.com/Clark, subscribe, please. And Clark will be back tomorrow with another episode. But today, you are an investment advisor. You're a fiduciary, as I've said before. And you met with some clients that inspired you to talk about the first thing you're going to get into today, right?
I never know what to talk about on the show, but I always go back to just what's happening in the world where I'm sitting down with families. And very often it's, wait a minute, that's a really good topic to talk about. So that's what we'll start with today.
Awesome. And then interest rates, something that most people are talking about.
I think that I know the media loves to hear about the Fed, and they have so much power and control over the economy, and we're in a transitional phase right now with the Fed in a lot of different ways. So I want to talk about what they're doing with rates and where rates may be heading.
Yeah, there's a constant guessing game. Is this news might mean that the Fed is going to do this with rates, and just constant feedback we're getting about that. So I'm excited to hear about that. And then, of course, I always have lots of questions for you.
Good. Let's get started.
Okay.
So this is a real life story, but I think that this question can certainly come up, and it's something to think about if you happen to find yourself in a similar situation. And we'll just say it's Marcia and Fred.
Okay.
And Marcia and Fred, I was sitting down with them the other day. Fred is 84. Marcia is 80. They have been retired a really long time because they both have pensions. Fred, by the way, 84, still playing tennis.
Wow.
3 times a week he's playing tennis. The other 2 times he has another activity in the morning. He's not playing pickleball. He just says that when he gets too tired to play tennis, he's going to then switch to pickleball. Anyway,
pickleball's too loud for me.
It is loud and it is dangerous. It is I think it's a dangerous sport.
Really?
So, yeah, it is. I think the way the word is quick, and you make these jerky motions because it's a smaller court, and you're running up and you're stopping, and that can blow out an ACL.
Oh,
okay. or an Achilles or a hamstring. So and I think the other thing is that it looks like you're just going to play ping pong, but really you're running all over the place. So it's unassumingly a little dangerous. Anyway, Fred's fine. He's been totally fine playing tennis. He's healthy. And the situation for them is a question about how they should allocate their assets. How much risk should they take? They're in their 80s. So right out of the gate, without knowing anything else about the situation, you would think, well, you may want to be more conservative. There used to be a moniker that had a whole lot. It was very widely understood and remembered, and it was from John Bogle at Vanguard. It's own your age in bonds. And the thought process was that, and it was a really easy rule of thumb to remember, and it kind of makes sense. As you age, whatever your age is, that's your percentage of bonds. So if you're 50% in bonds. When you're 70% in bonds. 80, should we be 80% in bonds? And I think that rule maybe 10 or 15 years ago, a little bit went out the door, and people don't refer to it as much. But there's still the thought, and it's an appropriate thought, that you may want to be getting more conservative with your investments as you age because your time horizon shrinks. And the shorter the time horizon as investors, the more conservative we want to be. If you're going to be spending money and you know that it's in 9 months, I need to spend a big chunk of money, you don't want it in the volatility of stocks because it could be 20% lower or 30% lower when you need it. So we say, well, if we know our horizon and it's a short horizon, we're going to keep money conservative. But what if you find yourself, and this is a great position to be in, that Fred and Marcia are in, which is 2 pensions, $3,000 each.
Wow.
2 Social Securities, $2,000 each. So do the math on that. That's $10,000 a month. 6 in pensions, $4,000 a month in Social Security. So they bring in $10,000 a month, and I'd put that in the guaranteed category. Is there anything really ever guaranteed in this world? No, but those are considered pretty much guaranteed income sources. And we know even with social, it actually rises along with inflation. So it even has inflation protection. But they only spend, they have their mortgage is paid off, they have no debt, their kids are well grown up and out of school, and their loans are paid off. So they just don't have any debt. And they don't need to pull money out of their accounts. They generate over $50,000 a year just in dividends and interest, and they don't use that either.
Wow. That's an amazing position to be in.
So they said, well, what is they're almost 75% in stocks. And they said, well, Wes, I hear that this is too aggressive for somebody our age. And as we talk it through, I said, well, okay, what do you think your time horizon is? What is your investment time horizon for the money? Not just your horizon, but what is these assets that you have? What is your time horizon here? And the answer is it's infinite, because they're really not even using it. They're not even touching it. So is there an end point for it? Well, really the horizon is their lives and their kids. Mm-hmm. So they have a couple of kids, and the kids will likely be inheriting this money. So their kids, let's say they're in their 50s, that's another 30 or 40 year horizon. So you can make the case that they have a 50-year horizon, or they almost have an infinite horizon. When you have guaranteed income streams coming in that I would say far exceed, in this case, several $1,000s every single month, your spending need, then your time horizon is to some extent infinite, which then goes back to, okay, well, how do you make a decision? I think this goes back to your investor preference more than anything. And usually as you're crafting an asset allocation and a diversification strategy, it is your preference, it's your risk tolerance, and it's your time horizon. Here, their time horizon is to some extent infinite, and they can just choose what their preference is. So that they may be 75% or 65% in stocks and another 10% in assets that are considered somewhat volatile. They're really comfortable with that. And as we talked it through, they understand stocks. They've been in stocks for years, and they're very comfortable with that, knowing that even if the assets go down with a market correction, they technically have an infinite amount of time to make it back up, because they are not relying on a daily, monthly, weekly, or yearly basis on those assets not going down. They can withstand some volatility. So it is, and if you find yourself in that situation, I would look at it as you now have this, call it new rule of thumb, that if you find yourself having plenty of income, your investment time horizon is either longer than you might think, or it technically could be considered somewhat infinite. And then you make the call on how you are comfortable personally and your preference on how you're invested.
Wow.
The infinite time horizon.
That would be a great thing to have for sure. Okay. We'll go to some questions for you, Wes. Renee in New York sent 2 questions in for you. 1, can you talk about the inverted curve yield, and do you think it will lead to a recession? And 2, what are some stocks that are recession-proof? We would all like to know that for sure.
All right, I'm just going to rattle off all my favorites right now. So the first topic here for Renee Renee's asking is, and I'm drawing this out as I'm talking this through, is the inverted yield curve. What is that, first of all? Well, if you think about, I go back to if you're only buying CDs, usually the way it's worked over the last 50 years is that the longer you lock in a CD, usually the higher the rate, right? A short-term CD might pay 3% for 1 year. But if you say, well, I'm going to do a 5-year CD, well, maybe that's 4 or 5%. And that's, to some extent, establishing the yield curve. Short-term rates lower, but as we lock ourselves in for longer periods of time, you typically get compensated more interest. And that is what is considered a normal yield curve. Short-term rates are a little lower, and as you go out in maturity, 5-year bond, a 10-year bond, a 30-year bond, the chart is supposed to look like this. It's supposed to be an arc, higher when you're investing for longer. What has happened, this has been going on now for the last 3 years, is that it's inverted. It's upside. You could also call it an upside down yield curve. Mm-hmm. So now we have short-term rates that are higher than long-term rates, and then eventually we get longer-term rates again, or higher rates again as we go out further. So it actually looks like this. And the worry about that is that there's been a good track record that shows when the yield curve is inverted, then we go into recession. So it's been a leading indicator for recessions. And it's been predicted, it's essentially, and this is how an economist would say it, the inverted yield curve has predicted 7 out of the last 5 recessions. What does that mean? Meaning that it'll send some false signals. It has preceded most of the recessions we've been in, but we've also had several different yield curve inversions. And 6 months, a year, 2 years later, we still didn't go into a recession. So it can be a warning signal that doesn't trigger the actual event. And here's why that may be the case, is that if it's inverted, the bond market, so the Federal Reserve sets the really short-term rate called the federal funds rate. They manually adjust that. And the media is always obsessed with the Fed in the next meeting and how are they going to adjust interest rates. But that's only at the very front end or the short-term part of the curve. But the thinking is if short-term rates are higher than long-term rates, the bond market, which essentially is a free market that sets where other interest rates are, is telling us that rates need to come down lower. Why would they need to be lower? Because the economy is slowing down. So it makes sense that if there's an inverted yield curve, the bond market's saying, well, the economy's slowing down. The Fed's going to have to lower to get the yield curve back to a more normal position. But we've been in an inverted yield curve for a long time. We haven't gone into recession. And I would call it now, maybe this is the 8th time that it's signaled recession and we haven't gone to. It's only happened 5 of the 8 times.
Okay. All right.
Defensive stocks.
Oh, yes. Sorry.
Renee,
Recession-proof
Krista
stocks.
was trying to cut off that.
I was going to go to the next question.
She wanted to keep going. Renee wants to know about defensive.
Renee, I'm
so
sorry.
I can't just throw out a bunch of stocks here, obviously. But I will say, I think of it more from a sector perspective. So what sectors of the marketplace are less cyclical? If we think about what would be a super cyclical area, think industrials. If a company makes bulldozers, when the economy's humming and everything's and we're building and building, then there'd be huge demand for earth movers, if you will. And then when things slow down, the demand can dry up significantly. Hey, we've got all the bulldozers we need. We don't need anything else for the next 2 years. So all of a sudden you have this huge demand and then a huge lack of demand, and it's really cyclical. What would be the opposite of that? Potato chips.
I was thinking like the energy sector.
Diapers.
Okay, yeah.
I think of things that no matter what's happening, you're pretty much buying the same paper towels. Minus the pandemic period when there was a huge surge for that. We were fighting to get some brawny paper towels.
Yeah.
So think of the areas that are consumer staple oriented. That to me is the ultimate defensive type sector. And yes, utilities.
Okay.
So not energy so much because energy prices are all over the place, but utilities to me are also in that very defensive camp to be looking at as staying steady from a company perspective during a recession.
Okay, Nate sent this one in. Wes described the worldwide stock market and said the U.S. portion is around 20% of the global equity market. The numbers he gives are $30 trillion U.S. out of $145 trillion worldwide, which is 20.69% if you do the math. However, everywhere else I look, it shows the U.S. at around 2/3 or 60% of world markets. For instance, any world stock index you look at. Perhaps Wes was conflating the world GDP if the U.S. is around 25%-ish. The point he was making was about stock ownership and diversification, though, so I am confused.
So I'm confused. I was probably just wrong, Krista. Okay. It should have been a Wes stinks.
Okay.
Is really what it should have been. I've read about this recently, and it is it's interesting. It's a little less, it's almost like the BLS statistics we've been talking about. It's hard to get, you would think you could just, what is the aggregate amount of stock value in the world and the aggregate GDP? It's so vast that it's hard to get it really exact. The other thing is that it can change really quickly. If you think about the U.S. markets, which are big, and I'll give you the percentage in a minute, when they're up 20%, how many new trillions is that? If you really think about it. So it changes really significantly. And I wonder if I'm probably wrong about this, and I'm really glad we are revisiting it. if you go back just 2 years and look at the end of 2023 or 2022, the numbers way different today because markets have gone up so much. Here's what I've read most recently, and I like the Visual Capitalist for this. They do a good job at this. Total world market cap right now for stocks, add up all the aggregate market cap value for equities in the world, it's about 120 trillion, and the United States is about 60 trillion. So it's half. So it's roughly half. A couple of years ago, it may have been in the high 30% range or 40%. Today, it's half. The bigger question, I think the reason that we're getting this question is how much should you have in international stock? Mm-hmm. That's the question. Even though the world stock market is only about 50% outside the United States, in my opinion, you still don't need 50% in international companies. Because our U.S. companies derive such a high percentage of their revenue by doing business overseas that we get a lot of global interaction just with U.S. companies. So to have 5 or 10 or 15% in international stocks, I think that is fine. But I'm much more comfortable having a much higher percentage than 50% when I'm looking at my stock allocation. I am predominantly United States, not 100%. But I think 50% in international stocks, in my opinion, is too much.
Okay. Alvin in Wisconsin says to Wes, thank you for your segment. I truly enjoy it and learn a great deal. Where can I find your advice on whether to take the employer pension lump sum or payments over time at retirement? A very common question if you have a pension, for sure.
It is. This goes back to the 6% test. And I know it's on our website at yourwealth.com. I've written about this a couple of different times. I've probably written about it in my Forbes column or article on Forbes.com. But I would just be looking for pension and 6% rule or 6% test, and that'll bring up those articles. But it really gets back to the point. If you do the math and you have a monthly promised amount that is, let's call it $20,000 a year. Or you could take, let's call it $400,000. What's the math on that? So 20 divided by 400, you're getting, that's 5%. So that you're under the 6% level, and you don't even want to consider the monthly amount unless it's 6+%. So in this case, you're better off taking the 400,000. If you were offered for, let's call it $40,000 a year in a monthly pension, or well, $40,000 annually that would be coming monthly, and $400,000, what would you want to take? That pension amount is 10%. A lot tougher to be able to make sure your money's doing 10% every single year. So in that case, you're probably better to lean towards taking the monthly amount that's $40,000 a year for the rest of your life versus taking the lump sum. And there's a lot more to it than just that, but that's the 6% rule. It's a really good starting guide to be looking for to make that lump sum or pension decision.
Okay. All right. Well, we're going to take a quick break, and then you're going to talk interest rates.
Welcome back to Ask an Advisor. Wes Moss, take off my glasses, along with Krista DeBiase. Krista, where are we headed next?
Interest rates, where are they headed next? That's the question.
That's good. You're right. That is what this is about. We're always watching the Fed. I think that the first item of business here is just to discuss why the Fed is so darn important. And I think of the Fed as it's really it is the powertrain, it's the engine of the U.S. economy, and it really controls the brakes and the gas pedal of the U.S. economy. Probably the better analogy is just they control the fuel line. So when rates are really low, the fuel line's wide open, and there is lots of stimulus or lots of gasoline getting to the engine, and the car can move faster. It doesn't mean it's always going to move faster, but it's meant to help the car move faster, the overall economy. When rates are high, restrictive, so then the fuel line tightens and there's less gas getting to the engine, things slow down. Remember, the Fed has this dual mandate. We want tame inflation, steady price stability, that's inflation, and maximum employment in the United States. Those are their two mandates. And really, their primary tool is controlling that fuel line. If we want to stimulate, open it up, lots of gas. If we want to slow things down or put on the brakes, you limit the fuel line, limit the amount of gasoline getting into the engine. Look no further than the U.S. housing market. If you go back and look when rates are really low a couple years ago, the Fed had a zero interest rate policy coming out of the pandemic, trying to stimulate the economy. Rates were zero on the Fed funds rate, which meant mortgage rates were ultra low as well, 3% or lower. We lots of people, you may have locked in a mortgage rate that was under 3%.
I have one under 2%.
Again, of course you would. Of course you would. You're the producer for the Clark Howard Show and a host. Of course you would. So what did that do? It made people say money was cheap. I can buy another house. I can move. Lots of activity. Housing market was booming. And a lot of that had to do with the Fed and interest rates. Today, the housing market's totally on ice. There's no movement in the housing market. On a relative basis, we see existing home sales at the lowest level we've seen for decades. A, because people locked in low rates and don't want to move. And B, mortgage rates are still really high because the Fed hasn't really lowered rates a whole lot. So it's a really good example of how powerful those Fed decisions on where they put interest rates, they really matter to the economy. Some sectors more than others. Housing is a great example. Now, if you go back over the course of history, and you can't see this chart here, but I went back to the late 90s or the early 90s, the Fed funds rate was right around this 5% range. And it was through the 90s, it was through 2000. And then as we got into... Then we had a recession and the Fed lowered rates in 2001. And then the economy got back to more normal and we started to have a housing boom. And then we all know what happened in 2006, really 2007. We had a total housing bust. And what happened? The Fed had to lower interest rates to try to stimulate the economy. So the Fed funds rate went from 5% down to 0 over the course of a couple of months. Huge change in the economy. Then the economy somewhat normalized. And eventually we were getting back to more normal rates, call it the year 2017, 2018, the Fed's raising interest rates at every meeting. We're trying to get back to, quote, normal. I don't know if there's an actual normal, but it's not, 0 is not normal. 10 is not normal. So somewhere in between is more normal, 4 or 5%. And as we were headed back to normalizing interest rates, what happened? The pandemic happened. Economy shut down. Everyone freaked out. How can we shut down the economy? Well, we need all the stimulus we can. And almost in a very short period of time, Fed took rates back down to 0 again. Then the economy started to recover. And what happened? We had huge inflation. Huge inflation. So what is their tool? Let's close up the gas line. Let's slim down how much gas is getting to the engine. They did it by raising rates. We went from 0 to 5% in a very short period of time. And it slowed everything down, particularly housing, slowed inflation down. So it worked. Now, the question is, where are we headed from here? So the higher rates are actually really good for savers. When we say saver, we are trying to delineate someone who would prefer to buy and own bonds, money markets, CDs, and just get an interest rate over owning stocks. So savers were really rewarded here. Money market rates were pumping out 5%. You could just leave your money in a treasury money market or some sort of even short-term bond fund, and we're getting highly compensated for it. Now, and I'm not really going into, yes, there's all these political calls for Jerome Powell's too late at lowering rates. That's really what really matters is that inflation, the latest inflation number we got was that CPI was 2.7%. That's not quite as low as they want it, but it's pretty close to the 2% level. So the Fed can say, okay, we have inflation in check. Number two, the latest jobs report revised down how many jobs we've been adding. So really, we haven't been adding that many jobs. Now, we haven't been losing a lot, but we haven't added a lot either. So the labor market's cooling. That all gives the Fed cover to lower rates again. And that's where it's very likely that will start happening at their next several meetings. The next one is middle September. It's widely expected, and there's a Fed fund tracker out there that shows there's over a 90% chance that the Fed is going to cut rates by at least 0.25%, maybe more. And the projections for where rates are going to be in 6 months from then, very hard to predict, but the indications that they'll continue to lower rates. And that has implications. We're no longer getting to sit in a money market account getting 5%. That rate's already come down to the 4 level and a little below 4. If they keep cutting, what we all need to be really cognizant of, are we just leaving money in money markets forever? And those rates will change almost overnight. They're really quick. Like the gas station is really slow to lower gas prices, even when energy prices go down. Money market rates are really quick to lower the rate because they're paying you out. So as soon as the Fed funds rate goes down, your money market rates will start to go down literally within the same week.
Wow.
So we just have to be careful. If we go into a lower interest rate environment, just be careful about money sitting around in money markets thinking, oh, it was getting 5 and then it was 4. That could go down really, really quickly. So know that, be cognizant of it as an investor and a saver to the new interest rate environment we find ourselves in, wherever that tends to be or lands over the next 6 months.
Okay. All right. Questions for you, Wes. This came in from Marcus in Arizona. I'm 27 and my wife is 24. We've just finished paying off about $12,000 in high interest debt over the past year, and our only debt is her student loans for $20,000 at less than 5%. We feel like now we can start to look toward the future. I feel my wife and I are both behind on retirement. I have about $20,000 for me and $5,000 for her, both in 401ks. I've been the sole income for the house for the past 1.5 years, but she plans to start working again this month. Where should we start and what program should we look into to start catching up? Thank you for all you do in the crew do. This is one of my favorite podcasts.
That's awesome to say,
so
Marcus.
Nice, Marcus. Thank you.
Marcus. So first of all, in your 20s, it's just hard to save anything. It's expensive to live in America. It's hard. The rent prices are through the roof. Housing prices are through the roof. Student loan debt is through the roof. And you've paid off a bunch of your debt and you have $20,000 left in student loans, which you're already chipping away at. And you guys have $25,000 saved. I can just tell you, I, in my 20s, had trouble saving a lot of money. You start having kids and you're trying to buy a house and there's the down payment for the house. It's really hard to get that initial nest egg started and that's starting to accumulate. But Marcus, you guys have already done that to some extent. You've already got $25,000. The median net worth in America, in somebody in their 20s, is $7,600.
I'm surprised it's that high, honestly.
So unless you've just worked, you were employee number 5 at one of these AI startups, it's really hard to that are now worth in the hundreds of billions. It's really hard to accumulate money in your 20s. It just is. So you are doing the right things by using the 401k. Just being cognizant of being a saver and trying to and having that saver and investor, even more importantly, mindset. That's what separates people that end up with a lot of money in 20 and 30 years versus people who don't. So that's number one. You're already on a good track. Number two, it is not just a marathon. It's the Iditarod. The Iditarod's that race in Alaska.
Yeah, the dog sleds.
You're on a dog sled and it's like in the dark for almost 2 weeks.
Yeah.
And you're mushing through the snow. That's what saving and investing is about. It's not just a marathon. It's longer than that. It's harder than that. It's the Iditarod. So just know that, and that'll give you patience and comfort that it does take a long time. What can you do about it? Stay in that mindset. I would read one of the books that really helped me, I think in my 20s and 30s, I still think about it, is The Automatic Millionaire. It was the most effective book, in my opinion, that just said, look, saving is hard. You almost have to trick yourself into saving and just do it automatically, which is 401k contributions, automatic contributions to any other account. It's automatically buying stock in a fund, an ETF, maybe it's a broad market index, and automatically reinvesting the dividends. So just put it on automatic. And if you do that, you're going to look up and you're in mile 37 of the Iditarod. You're going to say, wait a minute, we've got $100,000. This is pretty cool. And then you're going to look up again. I think this is over a 100-mile race. You're going to look up at mile 87 and say, wait a minute. Now the gains we're having on our nest egg are starting to really be material. And it starts to compound. And eventually the compounding is your friend. Well, it's always your friend, but you don't really see it until the numbers get bigger. The next thing you know, you have $1 million or $2 million saved when you're in your 50s, 60s, 70s. Doesn't matter. Well, it does matter. You want to get to that level, but you're doing the right things to get there. So keep doing what you're doing, Marcus.
I'd also say I've found that life changes. Like if you get a raise, and in this case, they've been living solely on Marcus's income and they paid out this high interest debt, $12,000 with his wife not working. So she's starting this job. Like now's the time to go all in on the 401k. Like just, go to 15% immediately or whatever the recommendation would be. And just when you get a raise, don't let yourself see the money. Put that money away. And that way you don't have that lifestyle creep that the majority of us have.
Really good point. It's save the raise. Mm-hmm. You now have new money that you don't have to be paying down on that original debt. That can be all savings now.
And her new income, if they're saving 15% of it, that's huge. Okay, Jerry in Ohio sent this in. I've never heard either Clark or Wes discuss the subject of placing your house into an irrevocable trust in order to protect it from being taken by the state in order to pay nursing home costs. When, if ever, is this a good idea? I'd love to hear the pros and cons of this arrangement. And if not an irrevocable trust, are there other ways of protecting your home?
Jerry in Ohio, so first of all, this is complicated and it's customized to every single person's financial situation. That's why, and it is a specialty within not just estate planning, and an estate planning attorney would be the type of person that would draft these documents for you and see what kind of trust. Maybe it's a Medicare, a MAPT, which would be a Medicare asset protection trust. Even more specialized than that would be an elder care attorney that really helps plan for how to structure your assets if Medicaid is potentially in your future. So it's a really specialized legal arrangement that you have to consider. An irrevocable trust is a big deal because you are essentially irrevocably forever putting a big asset into a trust. Mm-hmm. And it's no longer in your name. So how can that work? Finding and having the right trustee is paramount here. It's paramount. You've got to have a relative or someone that you really trust, you've known forever, that you trust to make the decisions. I mean, once it's in an irrevocable trust, you can't just say, I want to refinance the house. It's not your call. It's the trustee's call. And even though it can be effective for Medicare planning, it takes a lot of life steps to draw up all these documents, do the financial paperwork and legal work that it takes to get get an asset like that in the trust. And you've got to worry about the 5-year look back. If you're just about going into Medicare or worried about it, you can't just put your house in a trust. They have a 5-year look back rule. Jerry, so what I would say is that if you're considering doing some of this planning, you do want to do it when things are totally fine. When the sky is blue, that's when you do your asset protection type planning. And I think that's maybe an important takeaway for everyone listening and for you here and your question. But you lose control of the house to some extent. Irrevocable is permanent. So you've got to plan for this really early. And then there's some maintenance costs too. There's trust setup costs. There's maintenance costs for this. But I don't necessarily think it's a bad idea. There's other ideas that can maybe or potentially help with this too. A life estate deed. There's something called a ladybird deed that they use in Florida and Michigan and Texas that can do something, give you a similar outcome. So it's complicated, and I would be talking to an estate planning attorney or an elder care attorney that does this full-time for a living to dial in exactly what would be right for you.
All right. Well, that's going to do it for us for this week's episode. That's it.
Oh, okay.
Clark will be back tomorrow. Wes will be back 1 week from today with a brand new episode. Hope the rest of your day and week is great.